Shenzhen shutting down. This is a massive port, fourth largest in the world. How are you reading the implications?
Yeah, there's a lot of uncertainty. This is something that we thought we were largely done with or that was behind us, is the COVID impact. But China's zero tolerance policy has reminded us that supply chains are still subject to massive disruptions. And the COVID element in supply chains is still ever present. If remember back in the United States when Omicron hit, we really just sort of treated it as an unresolvable and sort of gave up on trying to contain it and just went about our lives. China doesn't seem to operate that way or want to operate that way, and because of it, I think we'll see a large disruption to global supply chains. This is expected to spread, or would expect it to spread if we've seen it, the precedent that was set in the West. And if it does, and China decides to continue their zero tolerance policy, it could have massive implications, very similar to what we saw in early 2020.
Craig, can you talk to us through the timeline here? If you do start to see the shutdown now in the ports, when does it kind of come back? When do you see the read through into the rest of the world? And where does that translate into things like shipping rates or trucking rates?
Yeah, it takes about 6 to 8 weeks for when you see a shutdown for it to impact the Western economies, just because it takes a while for that freight to ship. The good news for the American freight market, at least short term, is that there is a lot of still bottlenecks and at the ports. There's a lot of containers that are still available. So we have some short-term demand that will keep the freight market moving. But if this goes on for months or continues to be disrupted and we have fits and starts, it could have profound impact. As you mentioned, freight rates, particularly those out of China, it actually depressed those rates. If we start seeing ships not hauling cargo, but actually sitting at ports, we'll see freight rates drop because there won't be any demand. And so we'll see the alternative short-term really drop, but long-term, we'll also see a surge because a lot of those products there'll be a substantial backlog. So I think it all depends on how long and how pervasive this is throughout the economy. Really will tell us whether this is a repeat of 2020 or a short-term blip.
Craig, as we speak, WTI crude, the US benchmark falling below $100 a barrel. That's a $35 swing this month. How is that kind of volatility impacting the freight industry? Diesel, certainly a major factor here in Europe right now. What are you seeing? How much of this is kind of easy to pass on? Do the models cope with this kind of volatility? What impact is fuel having?
Well, the good news for the larger trucking companies, which have not had a lot of relief lately, just because of the driver shortage and the lack of being able to fulfill drivers, is that they'll be able to pass these costs on to shippers, people that buy capacity. So 75 to 80% of the capacity in the United States is fixed under contracts, and those contracts enjoy fuel surcharges. So a lot of those cost increases will be passed on to shippers and then ultimately consumers. As it relates to the spot market, that's where the squeeze is. When you see this really high, rapid increase in fuel prices, is it squeezes out the owner-operators, which operate in the spot market. And they did see a tremendous impact last week and over the last 2 weeks. And so short-term relief will be positive for the trucking industry, but we are seeing signs of a slowdown in freight demand. It's really, in many ways, caught us off guard because you normally expect the shipping season to pick up in March. March is one of the best months in freight, particularly in the domestic surface market, and that has not shown up this year. And so it's hard to understand what is causing that. But we are seeing a slowdown in freight, and therefore spot rates for those owner-operators, they're not able to pass on those fuel surcharges to shippers because they're simply just chasing the rate down.
Craig, a lot of what's driven some of that commodity volatility you were just talking about has been, of course, those geopolitical tensions with Russia, the Russian invasion of Ukraine. Can you speak to a little bit about what that means for the shipping market in particular, specifically around the Black Sea area?
Well, I think when you have disruptions and you see a lot of the agricultural commodities and other commodities, energy related, and just any of the mining commodities that come out of Ukraine and Russia, that has a tremendous impact on the global economy. But I think a lot of that is really European related. We do see high increases in rates for these products, and commodity prices really accelerate which impacts everybody. The good news for North America is that we're a net exporter of the items that are seeing these rapid increases, whether it's agriculture or a lot of energy commodities. We are a large producer of those. So in some ways that benefits particularly the freight market, because a lot of the industrial activity in the United States is tied to those commodities. So whether we're talking food or whether we're talking energy or energy related, a lot of our industrial economy is actually benefits when you see high demand. So in some ways,
but Craig,
at least long term, it could have a net increase in demand and in manufacturing in the United States, and that is a positive development. But certainly that will have a tremendous impact on prices. It could create an acceleration of inflation. All of that has a negative impact on global markets.
Craig, if we don't see wheat, corn, rye, etc., being shipped out of Russia or Ukraine, it has to come, I'm assuming, to the markets that it currently serves from further away. Is there the seaborne capacity to do that? Is there the capability to pivot and bring in crops from elsewhere? Does the global sort of food supply chain, how much flexibility does it have built into it right now?
Well, the good news is, particularly if we're looking at Europe being the most impacted, is there is an imbalance. There's more freight coming into the United States from Europe than there is going the other way. So that trade lane actually has a lot of available capacity. And so the ships that are able to transport grains from the United States into Europe actually have available capacity, and therefore I don't think it will be a capacity issue as it relates to freight out of the United States into Europe. So generally that's a positive, and it's true as well for Canada. And so North American, being a supplier of these grains, will actually be able to supply Europe with a dependable amount of supply, and shipping will not be a factor in disrupting that. All of this, of course, depends on how long this goes on and whether we see continuous outbreaks or an acceleration in geopolitical tension that impacts all of it. But generally, I think the U.S. and the Canadian agricultural markets, and really throughout the Americas, can handle it. And because they tend to be, particularly out of the U.S., tends to receive more freight from Europe than it sends out, it actually could in some ways balance those lanes.